Hello everybody and welcome. Good morning, afternoon or evening, depending on what time in the world you're joining us today. And thank you everyone for today's involvement. Today we're going to be covering as much information as we can around the topic of this webinar with my colleagues that you can see in front of me, a wide team to help everyone with these questions that we've received. The format for today is this will be recorded first off, so thank you to those who have submitted questions and looking back at this event. Equally, there is a function here that you can submit live questions. So if you've forgotten to submit them or want more detail on anything we discussed today, please do engage with us today and we'll try and make this as interactive as we can with everybody here. In a moment, I'm going to introduce you to my colleagues so you get a bit of a better understanding of who they are and our area of expertise. And then we've had a number of questions that have been submitted that we'll be going through the course of this event. We're looking for probably 20-30 minutes here to go through as much detail as you'd like us to with the questions that have been submitted. But as mentioned, we want to make this as engaging as possible for everyone, so please do keep those questions coming through. I'll be your host. My name is Steve and I work for a company called Lumon. We are an international payments specialist, so we help people move money internationally. In essence, we basically offer better rates and better exchanges and better service than the other banks. And to give you some scale, I'm on year 16 of doing this as of Sunday, so I've been doing it a little while. Next to me, I'm joined by the very knowledgeable Jim and Rob. First off, I'm going to come to Jim, if you can briefly introduce yourself to the audience that's joining us today and watching this back.
Sure, I'm an independent CPA. I have now close to 30 years experience. I started working with QROPS issues back in 2012, 2013. I've worked with OneSource. We're a full service accounting firm here in Tampa, Florida. And prior to this, I had extensive experience working with QROPS. When I was with BDO, back in 2013, we first started looking at how to report QROPS, and later in 2019, to make a long story short, in 2019, I was gave testimony during this for this SEC case, and I'm sure some of you may have been involved in this with DeVere. And then last year in 2024, I also met with, had a meeting with the DOJ and the IRS to again explain these QROPS and multi-pension concepts. So I think I have some pretty in-depth experience, some experience I did not want, but so I'm looking forward to answering your questions today.
Okay, thank you very much. Very knowledgeable indeed. Over to Rob. Rob, welcome. A little intro for everybody who's joining us today, please.
Yeah, thank you, Steve, and welcome, ladies and gentlemen. I don't quite have the 30 years of experience that Jim does, but I have been working in the overseas financial advice space for 8 to 9 years now, predominantly helping individuals migrating over to the US, setting up financial plans for them in the US, whether that's with their US domestic assets or indeed assets that they leave behind, such as UK pensions, ISAs, etc. So that's why it ties into this webinar quite nicely, because quite a lot of individuals that we help have either set up QROPS previously to speaking to us, or indeed have set up QROPS with us in the past as well. So yeah, hoping to give you guys some knowledge in regards to ongoing QROPS developments, things that you can do in regards to the actual structures, and alongside Jim and Steve, hoping to create better strategies and give people a bit more peace of mind that they are in the right structure and under the right guidance from a few professionals like ourselves. So thanks.
Great, thank you. And for those that are looking and wondering why I'm looking around, it's because I'm also the technical lead today. So as questions and bits come in, I will be responding to on a one-to-one basis as well. So please don't take any insult and think that I'm doing my emails in the background. I'm not. I'm engaging with the audience that's here today. Great, over to questions. So to Jim first, there's a question from Adrian, which was the status of IRS probes on QROPS, obviously.
Right, we haven't heard much from the IRS over the past several months. At the end of 2023, the IRS issued these temporary regulations, and then before that was the CAA that was announced, the Competent Authority Agreement. That is the document that the IRS has posted and contains these what appears to be modifications of the treaty. Since July of last year, I have not heard anything else from you. There's been no developments. I know I am aware of some clients that are under audit, and there have been no new developments. Actually, there's been some more positive developments with some of these, with only 2 audits that I'm aware of. So as it stands right now, the IRS has not finalized the regulations. I don't think they have, well, I believe they have not made any further announcements concerning the Competent Authority Agreement. And I have some comments about how the Competent Authority Agreement is, how this comes to play for QROPS. So I'll get into that. I think there's probably some questions on that.
Popular question indeed. Yep. Next one for you as well, Jim, is explaining in your views on the CAA and what's the basis of these views, and can you provide written opinions on applications of the CAA? This is a question that Ian asked most comprehensively, but this is indeed something that we got asked quite a few times, to be honest. So feel free to elaborate a bit further.
Sure. All right, it's not the first time I've heard that question, or these questions. Based on my experience over the years, what I know that changes a treaty, what you can look at is what's known as a protocol. If you went online to the IRS website and looked at any tax treaty, you will see the tax treaty. You may see a link to the technical explanations. And there's one for Malta. And then there's something known as a protocol. And I always, in my experience, look to protocols to see how these change the treaty. Very rarely do you see a CAA, a Competent Authority Agreement, change the tax treaty. And I think there are 3, I distilled the concepts or the issues with the CAA into 3 main reasons why I believe the Competent Authority Agreement does not change the treaty. And then the 3, I boiled them down to judicial precedent. I wrote them down here: U.S. pension plans, and legal and constitutional requirements. I mean, I think if you look at all of the arguments, and you can find a very good summary of these arguments at a government website. I can share the link. These were the comments that were provided to the IRS when they issued the temporary regs. They had a public hearing, and you were allowed to submit comments to the IRS. And these are public, and there's a 42-page rebuttal. There's a Bloomberg article on this, on how the IRS will have a tough time attacking the Malta pension, or and in this 42-page, it was great when I read it. It has, I mean, you can see it online. It has all of the concepts and reasons why the CAA, part of it is touches upon the CAA, and part of it touches upon the last year also the IRS initiated a criminal investigation into Malta pension plans, not QROPS, but these are Malta pension plans that were funded by U.S. residents. And so let's look at the 3. Judicial precedent. Again, there's other treaties out there that have different additional provisions that the Malta Treaty does not have. There's also the fact that the protocols are, well, with judicial precedent, there's the DeVere case. Back in 2019, after the DeVere case was settled, DeVere was fined roughly $8 million, $9 million. Long story short, the SEC and the US government, and this is the precedent, allowed approximately $10 million to be restored, put back into Malta pension plans. So when this case was decided, and the participants, maybe some of you here on the webinar or some of them, were allowed or given the choice, either put the funds back into your Malta pension plan or take the funds and they would be considered taxable. So I thought I was popping the champagne at that point. It's over. The government recognized the QROPS as a pension plan. Or that I wasn't worried about at that time, 2019, that they treated it as a pension. I was worried that they would ensure that the transfer from the UK pension to the Malta QROPS was not a taxable event. That's what I was celebrating, not the fact that it was a pension plan. I always thought it was a pension plan because under the treaty, if you even go online to the IRS website, look at the treaty, look at the technical explanations. It's a separate link. And on the technical explanations on page 11, it's clearly defined what a pension plan is. So when I say judicial precedent, we have the DeVere case. And, in this case, the SEC and the IRS, they don't communicate well. So we have a court case out there, folks, where the government already treated the QROPS as a pension plan. 6 years ago. 10 million went back in tax-free. So I believe, I'm quite confident that judicial precedent, one concept, CAA does not change that. Then we have US pension plans. If the CAA is valid, if that's in force or recognized as authority, then US pension plans, namely ESOPs, wouldn't qualify under the treaty. I don't think the CAA was well thought out. When they put this together, they didn't think it through. Because if the CAA now governs, then a lot of US pension plans are not considered pensions under the treaty. And we don't believe that's what the IRS intends. So you can tell this was put together and without thinking about all of the arguments, all of the concepts and the changes that a CAA would result in. So judicial precedent, DeVere case, government already treated as a pension plan 6 years ago. They've been treating it and accepting the tax returns for the past 12 years.
Well, I certainly haven't heard
3938, 3520. Again, so there's judicial precedent, US pension plans. If the CAA is in force and that is the governing change of the treaty, then many US pension plans don't qualify under the treaty. Can't be what the IRS intended. And then the third, legal constitutional requirements. You can't change a treaty without having a formal protocol. When you go online to the IRS and look at all these other treaties, you'll see formal protocols that are signed. I won't even get into the fact that when you look at the CAA online, it is not signed. I've heard some of those arguments. It's not signed. How can it be enforced? But I won't even go there. But I always thought protocols are what govern. If they wanted to change the definition of a pension plan, which is already clearly defined in the treaty and in the technical explanations, you got to have a protocol. And formally, then you're going to have to carve out ESOPs and some other US pension plans that don't have these limitations of only earned income. So those are the three big three reasons. And there are others, but those are the three major points. But if I said to the attorney that I worked with, when is the adult going to get in the room and sit with the IRS? Or let's have a discussion with the Malta MFSA and HMRC so that the IRS can understand what's a QROPS. I don't think they get it. And in my meeting with the IRS and DOJ lawyers, I humanized it. I said, what if you married a Brit and they had a UK pension plan or a QROPS? Is that, it's the same as having a 401k rollover. How could this be taxable?
Your knowledge and experience is coming out here, Jim, and the fact I haven't seen anyone quoting the page numbers in the document before as well. So you're definitely knowing your stuff. A quick question that's come in from Pete in the audience might be a bit too specific for just Pete. By all means, say that you'll go back to Pete after the event if you think it's too specific. But he's asked, for 10 years, I've happily filled the FBAR, the 8938 and 8833 for a properly formatted QROPS. Do I need to streamline and go back to filing the 3520, or should I just carry on as before? Jim, is that a question you can answer quickly, or is that too specific depending on Pete's personal circumstances?
I think I can answer that question and just carry on. I have made this argument or explanation to the IRS several times. There's only one audit I'm dealing with where the IRS focused on that issue. And their question is, why did you not use the 3520 and you use the 8938? Well, we basically are educating, many times are educating the IRS. We said, well, look, one, there are pension plans outside the country that are not trusts. They may appear to be, but they are contract-based pension plans because civil law countries don't recognize trusts. So, hey, IRS, Spain and France don't recognize trusts. You have this contract-based type format. 3520 has no instructions on how to report a foreign pension plan. It's designed for trusts. But IRS, you have Form 8938 that has 2 or 3 pages of instructions on how to report a pension plan, a foreign pension plan. So I think we have essentially, I think, one. When we get the final letters, I will laminate them and share them and put them on a mantelpiece. But everyone here has reasonable cause. And under the reasonable cause rules, doctrine, regulations that the IRS has published, you have reasonable cause for not, if you haven't, reported the pension plan on a Form 3520, and instead reported that on a Form 8938. You're essentially following the instructions. There are no, for the Form 8938, there are no instructions for Form 3520. You're providing the IRS all of the information they ask for electronically. 8938s can be filed electronically. 3520 forms are filed by paper, old-fashioned paper. Maybe Doge and Elon Musk's team will streamline this, and maybe we'll get this to be electronically filed. But these 3520s get filed by paper. They go to Utah, they get lost, they issue notices. It's a nightmare. And these are treaty-exempt pension plans. You have IRS Revenue Procedure 2020-17 that was issued in March of 2020. And I remember when it was issued, I was extremely happy because the headaches are going away, because the IRS in this revenue procedure specified that Forms 3520 are no longer required for treaty-exempt foreign pension plans. So I thought, party over, this is great. No more 3520s, although they have some, again, conditions that don't make sense, $1 million limitations, and in some cases, it appears that UK pension plans wouldn't qualify. So again, it's another weakly worded, structured, not well thought out. I don't know why they have these conditions in there. But again, the IRS, we have reasonable cause. I think if you have been consistently reporting on an 8938, I would say continue to do so.
Well, that wasn't a quick answer, but hopefully that was useful for you, Pete. Right, aware we've got plenty of other questions to go through here, so I'll try and keep them a bit more snappy for people. But equally, I would say, and for the disclaimer here, everybody's circumstance is different. The reason why all 3 of us are here is we're all helping and assisting in our way with regards to this planning. And also post-event, you'll be contacted by us as well to follow up on a one-to-one basis to make sure you've got your question answered, to see who you want to speak to next. And all of us, all 3 of us, as part of this webinar series, are offering free consultations on a one-to-one basis. So do please make sure to reach out to us post-event to follow this conversation. For your information, both Pete and Simon have said that that was a really comprehensive, good answer for you, Jim. So very happy. Right, I'm going to come to you, Rob, next with a simple, a short question, but it doesn't necessarily mean the answer is. I don't understand my charging structure. How do most QROPS charges work?
Yeah, I mean, QROPS are pretty straightforward, but I think when there's so many providers in the mix, I think a lot of people, especially if they set them up back in 2017, which a lot of people in the US did because of overseas transfer charges come into play, etc. You know, the lines get blurred, I think, for charging structures, and people often need to be, you know, they need to be refreshed in regards to how their charging structure actually works. And it's quite straightforward. So generally, you have the QROPS provider, which is the trustee. That's kind of the outside administrator of the pension plan itself. As Jim said, contract-based trust in most cases for US individuals. You've then got the underlying platform or bond provider. Now, depending on the advisor that actually facilitated the transfer, they would have either chosen a platform or they would have chosen an insurance type bond. Now, With insurance bonds, you can actually have two types of charging structures, which I don't think people are actually unaware of. You can have a commission-based life assurance bond, where, say, the client would have an 8 or 10-year period where there's exit penalties if they were to remove themselves. That is often derived from advisors charging an initial commission, which is paid out from that bond provider. But you can also use the same bond provider to use a transparent, clean model, which I think a lot of people are unaware of. So we use those clean, transparent models where there isn't tie-in periods, but it's still using the same provider to give the same benefits of being able to invest those funds accordingly to the client's risk profile. So you have a bond or a platform. Platform doesn't have any tie-in periods. That's just a standard brokerage account, let's say, which sits underneath the QROPS itself. So that's the second level of charges. You have the third level, which is the actual funds that the advisor would actually choose to invest in. So this can be ETFs, this can be active managers. In some cases, ones that I've reviewed have things like structured notes in, which we don't recommend. We don't think they're hugely transparent. So that's the third level of charges. The fourth is actually the advisor charges. So that's to obviously pay your financial advisor to actually manage the ongoing investments and the QROPS and provide you an ongoing service. I've been reviewing quite a few of these recently. Generally speaking, the QROPS is between $1,000, $1,300. The bond provider, that might be an extra 1% or 1.2%, depending on the commission level. There'd generally be a fixed fee of about £400 to £500 as well from the platform. The funds, now this is quite a big point, which is what we've been reviewing a lot for clients. A lot of them have been in actively managed funds, so that could be an extra 1 to 1.5% on top of those. If you were to use, ETF passive funds, that can be reduced to, 0.1%. You've then got advisor charges. Generally, offshore market is 1%. Flat rate basically. Now we do have a regressive model where the more that's invested, the lower that percentage is. So it incentivizes clients to come with us and actually be with us for the long term. So there is a number of I guess levels to the charges. So it's understandable why clients can get caught up and don't understand where the charges are going. But it's important for people to understand, because ultimately that's going to impact their performance. If people are paying upwards of 3%, but they're a balanced investor, then that's pretty much half of their annual performance gone just by charges. So it's really important that people review those and reduce them wherever possible, really.
Good answer, and more people coming in saying that this is useful, so great. I'm glad that everyone's finding value in what we're going through today. Next question, I'm coming back to you, Jim. Based on receiving written advice, a number of clients have already completed an IRS streamlining process. This question is a long one, so let me get it all up here for you, sorry. So it's an IRS streamlined process to restate their prior 3-year tax QROPS filing onto a taxable basis in line with the CAA position that QROPS is not a pension. And we kind of talked about this a little bit earlier. What should these clients do next? Should they continue filing in this fashion or revert to a previous views? Again, this will be case by case a little bit, I would expect, and I'd encourage the audience to engage with Jim post-event to have that conversation on a one-to-one basis. But anything else you would add, Jim, from a top line?
Right. I've worked with a couple of clients who have maybe not the same circumstances, but have taxed the QROPS or have not treated it as a pension. And one of those was to avoid penalties. It's a more specific case, but I've worked with Rob, and what I would suggest, if you've already treated it as an investment account, a taxable account, then why don't we look to see if we can move those funds, because now you have your basis in the funds. You're picking up the income every year. Then maybe you can look at repatriating those funds, maybe taking the 25% PCLS or the tax exempt lump sum and repatriating those funds and possibly putting it in, redeploying those assets, working with Steve, working with Rob, bringing the funds over and redeploying those into either an annuity, for example, or a well-structured life insurance product, whereby you continue or you restart, because you set this, the QROPS is for retirement income. I mean, that's the purpose. Then you can redeploy and repurpose those funds into a tax deferred, possibly tax exempt investment structure. And we can discuss how we can, in your individual circumstances, either look at an annuity or look at life insurance and almost mimic what you were going to receive by having a QROPS, by having those funds here in the US invested the way you want, with control and with the possibility of tax exempt income in the future. So Rob and I have been looking at these strategies for this case, because for these situations where, and I've had one client who in a similar situation. What do we do now? Well, let's bring the money home. Let's redeploy it. No more, and when you bring it into some of the solutions that Rob and I have, no more foreign reporting, no more IRS problems or scrutiny. Maybe the fees, there may be a savings here on the fees, and you are redeploying those assets, investing in US and other investment choices that you may not have with the QROPS. So there are some good strategies here to rescue these funds that are in a QROPS that you may have already taxed or had to have taxed. And so there's some good solutions here.
Yeah, and I think that depends on the kind of route that they choose to go down. There's people that have already gone down the listed transaction route. So for them, it's pretty simple to put together a strategy of redeploying them to the US. But people that haven't gone down that route, then there still is, the decision as to whether to go down the listed transaction route or to keep reporting it as a pension. So that's a decision that I think the individuals need to discuss with the professionals and see which route would actually be better. I know some individuals would like to just get rid of their QROPS because they've just had enough of it. So, potentially reported transaction route could be an option, but again, you need to see what the taxable liability would be and what the options are for redeploying it in the US. Otherwise, try and reduce fees where possible in the QROPS and make sure, it's invested correctly and transparent so that you can continue reporting it and obviously pay the tax as and when you take distributions from it that way. So 2 options for people there, really.
Right, and the one case that I'm working on, we're taking the funds as soon as we can, because inside the QROPS possibly there are these PFICs or these foreign mutual funds that are not tax advantaged at all. So when we look at what is, what's in the investments that are in the QROPS, we can make a better assessment. So also that potential problem with foreign mutual funds and these passive foreign investment company reporting and tax problems will also go away.
Mm-hmm.
A couple of people have asked for the a link to your Bloomberg report that you mentioned there as well, Jim, with regards to that, the QROPS article you referred to. So if you can share that with me, I'll try and get that communicated out to people if you can send that over to me. Good feedback from Simon as well, so thank you, Simon, for your engagement today. Hope everyone's still finding this very useful. The feedback seems to be yes. A quick question that someone had asked around currency, which is my area of expertise, plainly, around how to plan that, because obviously investing in and taking funds out, that normally means that funds are moving between currencies, and how people manage that. Without using a currency specialist or broker, i.e. someone in our field, normally you just provide a destination bank account for where the funds to be sent through to. The challenge with that is that the funds normally then arrive and the bank will apply a fee for transferring that over, and indeed a fee on converting that money. So you'll often lose control over the exchange rate you get and the timing of that transaction. And to give an idea, with President Trump in, the dollar rate of exchange has been very, very volatile in the last 4 months. It's moved by over 9% in the last 4 months. So the important bit here that I'd highlight is, please don't just assume that currency's on the to-do list and I'll do it at the end. Make sure you're proactively looking at that. In the nicest of ways, if we couldn't provide a value or provide a saving, we wouldn't be here. And to give some scale on the firm that I represent, we're trading in excess of $30 million a day for our clients. We're doing billions and billions here as a result of the value we can add and the saving we can provide. So please, when you're talking to Jim and Rob, they'll point you in my direction as well. But when they do, remember to go, oh yes, Steve on that webinar, yes, I need to have a conversation with him about it, because yeah, there is a benefit, and that's the part of the reason why I'm here. Right, I'm going to come back to you, Rob. Can I change my QROPS provider? That's a nice easy one, but that one came in a few times. Is that easy to do?
Yeah, simple terms, yes. You obviously have to look in regards to the exit penalties you've got. I mentioned those levels of fees that you have when changing a QROPS provider. You need to also look at the underlying platform as well, and what exit penalties you have on that. I think a lot of people that was reviewing, a transfer back in, say, 2017. So you'd like to think that most of them are actually coming to the end of their kind of 8 to 10 year charging period. Changing the trustee is pretty straightforward. You can essentially just move the assets from one trustee to the other, and that shouldn't be a taxable event because it's just QROPS to QROPS. But the further planning or more in-depth planning is needed surrounding the underlying platform due to some of the exit penalties, that might have been employed by the initial advisor on the case. So yeah, QROPS provider can be changed, platform provider can be changed, funds can be changed, advisor can be changed. The whole QROPS can be changed if you want to review it. So it's just understanding which ones can be reduced in the short term and which ones can be, what fees can be reduced in the longer term based on some of the time periods, etc., which are in force at the moment.
Thanks, Rob. Next one, sticking with you as we come to the last couple of questions that have been submitted. So if you're in the audience and watching this and want more questions answered, please do pop them in. I have a UK pension. Can I still transfer to a QROPS?
Short answer, short answer is no, but essentially back in 2017, there was the overseas transfer charge that came into play. I think it was March 2017, where basically the HMRC put a 25% tax charge on any transfers to QROPS when the individual lived outside the EEA. So technically you can still transfer to a QROPS, but you'd be hit by a 25% tax charge. So probably not financially viable in the majority of cases. But actually just in the UK budget, HMRC and the UK government have just basically made the 25% overseas transfer charge in force to anybody, not even just those that are outside the EEA. So the only way to get around the tax charge is if your QROPS is in your country of residence, and the QROPS list in the US is very short and the QROPS providers are not very big, so we wouldn't recommend actually transferring over to the individual's country of residence in most cases. So there's other options such as UK SIPs and international SIPs, which is still UK FCA regulated products, which we work with tax reporting with Jim on. And obviously, if they're in GUP and there's distributions, working with yourself, Steve, to help take the distributions over to their country of residence, for example, the US for the majority of people on this webinar here. So makes it much more efficient when it comes to strategizing and being able to make sure, again, it's in a transparent fee schedule as well. So all super important points.
Good answer. What I'd also highlight at this point is something that we always seem to come across, all three of us in our lines of work when we're talking to a client, is that the biggest mistake we see is people leaning on Google or nowadays ChatGPT to just do a search and think that class is advice. Please, many people fall in that trap. None of us would recommend it, which is again part of the reason why we're offering those free consultations with you all, whether or not indeed you're joining us live right now or you're watching this recording at a later date. Just get in contact with us, referring to this webinar for that free conversation, so you get the live, up-to-date information. So obviously you can make a more informed decision as to how you're making your financial planning. Jim, over to you for the penultimate question. I've been following Jim's advice via STM regarding taxes, but should I now be filing a 3520A forms? What effect does the CAA have? Probably a big question here, so try and respectively keep it to point as well, but off we go, Jim. What do you think?
Sure. Right, I don't think the CAA really affects the reporting requirements. Again, if you've been reporting the QROPS on a Form 8938 be consistent. I would say consistent because if you were to, in a practical answer, if you were to change to a 3520, first the 3520A is actually filed by the foreign trustee, which none of the Malta pension providers complete. There's only one company that does that I know of, and that's Dominion. They actually file the 3520As. 3520As are to be filed by the foreign trustee. If they do not file them, then you attach it to your Form 3520, and on the top right, you'll see a box that says substitute form, and you check that box. So the 3528 goes with the 3520. And that's mailed into the IRS in Utah. Now, if we mail that in and we switch from the 8938 to the 3520, again, this is going to be paper filed, processed. And the fact that on the form, it'll show that the trust was formed in 2017, and this is the initial 3520, we're going to deal with years and years of IRS notices. Because what Utah does is they automatically send out a computer-generated $10,000 a year penalty. And that's going to cause a lot of stress and back and forth with the IRS. And the notices are going to be issued every 3 months. And you're going to get stressed out. And they're going to threaten to seize 35% of your foreign trust. And we're going to have to go to taxpayer advocate, which I've already done in a case where the IRS asserted that, oh, you didn't file it, we didn't get it, it was late. And we had to show them the postal receipts. But it's just going to open up a world of stress and fees and headaches because the IRS in Utah has no idea that you've already been reporting this on a Form 8938. So I think we're just, from a practical answer, if you've been reporting and providing the IRS that information on the 8938, again, you have reasonable cause. Back in 2016, I helped STM. Some of you have seen this. This is from 2016, but I've helped put together this reporting guide for STM. And I showed this to the IRS as well. And it's a reporting summary on how to report your QROPS, and it explains contract-based pension plans. And I put together on here an example of the Form 8833 that you would file with your 1040, if you can see this. So this has been out there for quite a number of years. So I've shown this to the IRS and said, look, most of the QROPS, all of these QROPS beneficiaries have been reporting these. We've been doing the right, we've been providing correct advice, reasonable cause. And so I think if you've been reporting it, be consistent, continue using, if you've been reporting on Form 3520, continue to do that. Actually, if the pension's under $1 million because of the revenue procedure in 2020-17, you can stop. And actually in that revenue procedure, if you were penalized in the past, you can get your refund of any penalties. I don't know, none of my clients have been penalized, but that's a really great revenue procedure. And the CAA doesn't reference it. Nobody's referencing it, but it's out there. And I think just, again, the IRS, you have one office in Utah, is not communicating with Washington, and they're not communicating with Austin. So we'll navigate this together, not a problem.
Thank you. And the last question before we go on to leaving notes for it. Another one for you, Jim, to be honest, even that probably includes all of us. What's the most tax efficient way to exit from a Malta QROPS and move the funds to the US? All three of us will probably be involved in this answer, I imagine. Jim, do you want to go first?
Yeah, I guess the first step would work with Rob and I to determine what funds are within the QROPS, and what not only the tax implications of liquidating those assets, because if you do have some of these funds, they can't be transferred in specie, so we're going to have to sell them. So we're going to have to look to see what is the potential capital gains in those securities that are within the QROPS. We'll work together with Rob because he has to determine if there are any surrender charges for some of the investments that are in the QROPS, which I'm going through that exercise now. And then what we look to see is if you have not taken your 25% tax exempt lump sum, then that's another factor that we can look at. Maybe we take the 25% in one tax year, officially take out other distributions in another tax year, because we're going to then have to look to see what the tax your effective tax rate will be. You know, again, that's more of a personalized, customized plan. Rob, do you want to add anything there?
Yeah, well, I guess again it comes down to that question of have they gone through the streamlined reported transaction process, or are they still, you know, reporting it as a pension? Because there's going to be two different, you know, I guess liquidation strategies then, depending on which kind of, you know, which road they've taken. Obviously, if it's pension scheme, then yeah, most likely take the PCLS depending on their state, etc. And then drawing it down over a number of years based on, you know, their other taxable income that they've got. If it's reported transactions and it's, you know, seen as a brokerage type account, then, you know, what kind of PFIX they've got in there. Is it worth just liquidating those positions straight away and trying to, you know, ripping off the band-aid per se and just moving it over straight away, and then looking at what the exit penalties of the providers are as well. So two different strategies depending on, I guess, how it's being reported, but definitely areas that we will be able to help in there depending on which route the client has taken or is looking to take. But then, yeah, coming on to Steve as well, I guess. Obviously, if funds are getting deployed in either one of those strategies, using Lumon makes it much more efficient to move funds over from GBP to US dollars if they still are in GBP, of course. So,
correct. And it's also around making sure that all the paperwork's in place across all three of our services to make it as efficient for you as the client as possible. From the currency perspective, it's not just the basic element of our rates are better than the bank and therefore you're investing more, which is obviously the aim. And to give some examples, I've had occasions recently when the percentage differences has been a whole number of percentages. And when you're chasing returns of a couple of % a year, just giving it away to the bank isn't always wise. The other aspect is timing that transaction. With the market moving so much, the pound dollar, the dollar euro rate has moved by multiple % in the last 10 days. And with Trump as active as he is on Twitter, now X, we're not expecting the cable price or the dollar price to stay stable in the Commonwealth now. So timing those transactions can be really beneficial to make a big difference. Right. Okay. Well, coming up to the end of the session, we want to say thank you for everybody again. As a reminder, you'll get a copy or you get an email from us later on this evening, today, this morning, depending on your time zone. Feel free to provide that email for a request of the recording of this event to go back on. And obviously, you'll have our contact details so that you can speak to us all directly with that free consultation. My other leading point is, again, as a reminder, please don't lean on Google or ChatGPT. We're paid as professionals for a reason because of the value and benefit we can provide, so you can make that informed decision. I want to say thank you again to the two wonderful people standing next to me, even though I need a tie for next time to stand up with Jim. But hopefully everyone's found it useful and as much fun as we can make this topic for everybody. The feedback has been good already, so thank you for those that have responded saying that they've enjoyed it, and the substantial and the detail that's been provided in this session is always nice for us to hear. The last thing I'd also add is if you'd like other topics covered going forward, please do let us know. We're here as service providers to answer your questions and provide as much value as we can. So if there's a budding question or a topic that you'd like us to focus on future events, please let us know. Great. Well, Jim, Rob, any leaving notes from you before we wish everyone goodbye?
I think you've rounded up pretty well there, Steve. But yeah, obviously a lot of opportunities here to review QROPS and ongoing strategies from a tax, currency, and fee perspective. So yeah, feel free to reach out to all of us, and we'll be happy to look at the overall structure and see what can be improved.
Right. Yeah, and my message is be proactive. You know, let's plan ahead. You don't want to. It's not great when we're fixing the plane while it's flying. So let's get together and think of a plan with Rob and Steve to see, you know, what we can do with your QROPS and redeploy those assets possibly. And again, also put your mind at ease, right? And that was my goal here today. Our goal here today. So
yeah.
Everybody. Have a good afternoon, evening, and goodbye. Thank you, everybody. Goodbye.
Thank you very much.
Thanks.